Stop. Your index fund isn't protecting you from the market, it is the market. And that's the most dangerous thing you've never been told. Marcus was 34 years old, engineer, stable job, decent salary, did everything right. He set up his 401k, picked an S&P 500 index fund, and invested every single month. He slept well at night because he believed he was safe, 500 companies, diversified, protected. Then March 2020 hit. The market dropped 34% in just 33 days. Marcus opened his app, and everything was down. Apple, Microsoft, Google, Amazon, one after another, all red. Every single one. He thought he owned 500 different companies. But they all moved like one, because they were one. And that's not his fault, no one ever told him what he actually bought. So let me show you. An index fund tracks an index, and the S&P 500 tracks the largest companies, not the best, just the biggest. And the bigger a company gets, the more of your money gets pushed into it automatically. Not because someone made a smart decision, but because math forces it. Apple grows. More of your money goes there. Nvidia doubles. Your retirement follows. The fund doesn't ask if the price is fair. It doesn't think. It just buys. Right now, the top 7 companies make up over 30% of the entire index. 7 out of 500. That means when you invest $1, nearly 30 cents goes into the same group of tech-driven companies. That's not diversification, that's concentration wearing a disguise. Think of it like this. Imagine a restaurant with 50 tables. Looks healthy, balanced, successful. But 7 of those tables generate 80% of the revenue. The owner can't change it, can't rebalance it, can't fix it, he just sits there hoping those 7 tables keep spending. That restaurant is your portfolio. And those 7 tables are Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, and Tesla. And you have zero control over the seating chart. Now here's the uncomfortable part. These companies are already priced for perfection. The market is betting they will grow, forever, at insane rates. But what happens when they don't? That's where things get dangerous. There's something almost nobody talks about, it's called a liquidity spiral. Today, over $13 trillion sit in passive index funds. And when fear hits, people don't sell selectively anymore, they sell the index. Everything gets sold at once. Apple, Nvidia, the small companies, everything. No decisions. No thinking. Just automatic selling. And that selling feeds more selling. It spirals. We've seen glimpses of this before. In 2010, the market dropped 1,000 points in minutes, and then bounced back, like nothing happened. No news. Just algorithms selling each other. In 2018, the market fell 20% in 3 months, not because businesses collapsed, but because money kept leaving. And in March 2020, the fastest crash in history. Not because every company failed, but because everyone owned the same thing and ran for the exit at the same time. When everyone rushes the same door, the exit becomes the danger. That's passive investing at scale. But listen carefully, I'm not saying sell everything. I'm not saying index funds are a scam. I'm saying the version you were sold years ago doesn't exist anymore. The game changed. Your strategy didn't. And that gap, that's where money disappears. Marcus didn't lose because he was careless. He lost because he was using outdated assumptions. And that changes today. Here's what actually matters now. First, check how much of your portfolio is concentrated in tech. If it's over 30%, you're not diversified, you're exposed. Second, add international exposure. Not because it's exciting, but because it spreads risk and often comes cheaper. Third, own something that doesn't move with the stock market.